What if I told you that 11% of your money every single year could be yours? You'd take that deal in a heartbeat, right? Now, what if I told you that same 11% could quietly destroy a third of your savings? And you wouldn't even realize it until you'd already lost years of progress. Here's the uncomfortable truth that most dividend investors learn the hard way. Ultra-high yields, anything above 8, 9, 10%, they often come with a hidden cost that wipes out every penny they pay you and then some. But there's a number. One number, a 75% payout ratio that instantly exposes whether your yield is built on actual profit or whether it's being financed by debt and wishful thinking. I'll show you exactly how it works by the end of this. Let's start with a story. And I want you to imagine your friend comes to you, says they found this incredible investment. It's a fund, pays an 11% dividend yield. They're excited. They dump $50,000 into it. And sure enough, every month, money shows up in their account. In the first year, they collect about $5,500 in cash. Feels amazing. They tell you about it at dinner. They show you the deposits. But here's what they're not watching. Over that same year, the share price drops from $25 down to about $16.75, a 33% decline. So yeah, they collected $5,500 in cash. But their $50,000 investment is now worth roughly $33,500. That's a net loss of $11,000. The yield was real. The money hit the account, but the total return was deeply, painfully negative. And here's the psychological trap. Your friend doesn't feel like they lost money, because every month cash shows up. It feels like a paycheck. But if they needed that $50,000, if they had a life event, a medical bill, a down payment, they'd suddenly realize they're $11,000 poorer than when they started. This is what the finance world calls a yield trap, and it is everywhere right now, especially in the corners of the market that target income-hungry millennials who are trying to build passive income. Because passive income is the dream, right? That's what the influencers are selling. Quit your 9 to 5, live off dividends. The problem is, yield isn't the same as return. Yield is just what a position distributes. Return is what you actually keep. And those two numbers can be wildly, catastrophically different. So why does this happen? Why do these ultra-high yields so often come with collapsing prices? It comes down to where the money's actually coming from. A healthy company or fund generates profits from its business. Let's say it's a real estate fund collecting rent, or an energy company selling oil, or a bank lending money. That's real revenue. After expenses, whatever's left is profit. A well-run company might distribute maybe 50, 60, 70% of that profit to shareholders as dividends. The rest gets reinvested to grow the business. That's sustainable. That's how you build long-term wealth. But now look at what happens with ultra-high yield positions. When a fund promises 11, 12, even 15% yields, but it's only generating enough profit to cover maybe 4 or 5%, something has to bridge that gap. And that something is usually one of three things. Option 1, they borrow money. The fund literally takes on debt to pay you your dividend. That's not income. That's a loan you're receiving that you'll eventually pay for through a lower share price. Option 2, they return your own capital back to you and call it a dividend. This is super common with closed-end funds and MLPs. They're not generating 11% in profit. They're just handing you back your own money and calling it yield. It's like reaching into your left pocket, pulling out a 20, putting it in your right pocket, and calling it income. Option 3, they use accounting maneuvers. Covered call funds, option premium strategies, non-GAAP earnings adjustments. These can generate cash in the short term, but they often erode the principal over time. Any of these three strategies can produce a flashy yield number, but none of them create real, sustainable wealth. Now, that number I mentioned at the beginning, the 75% payout ratio. Let me explain why this is the single most important metric to check before you buy any dividend-paying position. The payout ratio tells you what percentage of a company's actual earnings are being distributed as dividends. If a company earns $4 per share in profit and pays out $2 in dividends, the payout ratio is 50%. Simple. Now here's the benchmark. 75%. That's your ceiling. When a company pays out 75% or less of its earnings as dividends, that leaves a quarter of their profit for reinvestment, for growth, for building a cushion during tough times. But when you see a payout ratio above 75% and especially above 100%, that's the warning sign. That tells you the company is distributing more cash than it's earning, which means that gap has to be filled somehow. Debt, asset sales, return of capital, all the stuff we just talked about. Let's do some real numbers. Take Payout, which millennials love because it used to yield around 7%. In 2021, their payout ratio was over 90% of free cash flow. The dividend looked juicy, but the share price went from around $39 in 2016 to about $24 by 2022, a 38% price decline while collecting that 7% yield. If you'd invested $10,000, you'd have collected roughly $4,200 in dividends over those years. Sounds decent, but your $10,000 would be worth about $6,100, net loss of about $1,900 even after collecting every dividend. The payout ratio was screaming above 75% the entire time. The math was telling you it wasn't sustainable. Now compare that to a company like McDonald's. Yields about 2%. Not sexy. No influencers bragging about a 2% yield on social media. But their payout ratio is typically around 55 to 65%, well below the 75% threshold. And the share price? It's gone from roughly $120 in 2016 to almost $300 by 2024. That $10,000 investment? It would be worth over $40,000. Plus, you collected dividends the entire time. The lower yield was real. The higher yield was a mirage, and the payout ratio told you which was which before you ever bought a single share. Let's look at another example. Realty Income, the monthly dividend company. Popular among millennials building passive income portfolios. Their yield has historically been around 4 to 5%, and their payout ratio? Usually around 70 to 75% of adjusted funds from operations, right at that threshold. Not perfect, but it's been sustainable because their business model, owning commercial real estate with long-term leases, generates consistent cash flow. Now compare that to mortgage REITs like Annaly Capital. This thing yields 12, sometimes 14%. But the payout ratio relative to actual GAAP earnings, it's been over 100% in multiple years. The share price over the last decade has gone from roughly $18 to about $18, flat. While you collected those fat dividends, your principal went nowhere. You didn't lose money exactly, but you didn't build wealth either. And if inflation averaged 3% over that decade, your purchasing power actually declined. A 12% yield that doesn't grow its principal is actually losing you money in real terms. Here's a framework. A simple 3-step filter before buying any dividend position. Step 1. Check the payout ratio. If it's above 75%, you need to investigate further. If it's above 100%, walk away unless you have a very specific thesis. Step 2. Look at the share price or NAV trend over 5 to 10 years. Not 1 year, 5 to 10. If the price is steadily declining while the yield stays high, that's a yield trap in progress. The fund is cannibalizing its own value to maintain the distribution. Step 3. Check whether the distribution is classified as ordinary income, qualified dividends, or return of capital. If a big chunk is return of capital, you're literally getting your own money back. 3 checks, under 75% payout, stable or growing price, and real income, not your own capital being recycled. If any one of these fails, proceed with extreme caution. Now, I know what some of you are thinking, but what if I'm just living off the income? What if I don't care about the share price because I'm never selling? Here's the problem with that logic. Companies and funds that consistently pay out more than they earn eventually face a reckoning. They cut the dividend, and when they cut the dividend, the share price typically collapses overnight. Not gradually, overnight. When Payout finally cut their dividend in 2022, the stock dropped over 7% in a single day. When Frontline cut its dividend in 2015, the stock dropped 22% in a week. You don't get to choose when to sell. The market chooses for you. And there's another problem. If your yield trap cuts its distribution, your income drops too. That passive income you were counting on to pay rent or cover expenses, it just shrank. So you're not only poorer on paper, you're poorer in cash flow too. The 75% benchmark matters because it gives you a margin of safety. When a company stays under that threshold, they have room to maintain their dividend even if earnings dip during a recession. They can absorb a bad quarter, a bad year without cutting your income. But companies above 75%, they have no buffer. One bad quarter and the dividend is on the chopping block. One recession and your passive income dream becomes a passive income nightmare. So let's bring this full circle. Your friend with the $50,000 and the 11% yield, they collected $5,500 in cash, but they lost $16,500.